Hello and welcome to UCI Beal Applied Innovations VC Speaker Series. It's our webinar featuring conversations with VCs and investors. Our goal for this webinar series is to continue to connect the Southern California innovation ecosystem with the experts and resources that will help entrepreneurs and founders navigate this current crisis and thrive in the recovery that we all expect. For today's webinar, we're honored to have with us both Bruce Hallett and Sherman Atkinson from Miramar Digital Ventures. So for those regular attendees, you'll notice we actually have two for the price of one today. It's great. This is going to be our first three-person webinar. So Miramar Digital Ventures is a Corona del Mar-based fund that makes seed and Series A technology investments. And we'll get into all of that in just a little bit. But first, as always, I want to thank and acknowledge our sponsor for the VC Speaker Series, Kenobi Martins. They're consistently ranked as one of the top intellectual property firms in the nation and worldwide. They have close to 275 lawyers and scientists, and they dedicate their practice to all aspects of intellectual property and technology law, including litigation. The firm is headquartered here in Orange County, and we're very fortunate at UCI Beal Applied Innovation to have Kenobi as strong supporters of our mission and the VC Speaker Series. So more information about the firm can be found at www.kenobi.com. So, all right, a few webinar details, as we mentioned every week. So unlike Zoom meetings, you can't unmute yourself on this and you can't turn on your video. But if you have any questions, please type them into the Q&A box, not the chat box. And I'll moderate and ask the questions that are relevant to the discussion, either throughout or at the end. And if you have very specific questions, then Sherman Atkinson is committed to kind of stay on the online, and we'll answer some of those questions privately within the Q&A box. If it's a very specific question that's not really meaningful to the rest of the crowd, we'll answer those then. And there will also be a recording of this webinar, and it'll be available on the UCI Beal Applied Innovation website early next week. So at this time, Sherman and Bruce, why don't you guys go ahead and join me here online, and we'll get started. Great, there you guys are. Good to see you guys.
Hi, Luis.
Good to see you, Luis.
Nice. Okay, good.
Welcome.
No, it's our pleasure. So Bruce, you and I have known each other for quite a long time, and as I think I noted earlier, there may not be another tech VC in Orange County that has more experience than you do. So we're thrilled to have you today.
That's right. You've known me since before I had gray hair.
Oh yeah. Listen, and speaking of hair, so I was going to say the pandemic has been good for some and bad for others, including the beard trimming companies, because I want to assure everybody on the webinar that that the person that says Sherman Atkinson is the same guy that was on my slide before. So can you verify that, Sherman? You're the same guy, right?
Same guy.
Okay. Good.
You forced me to get a haircut, Luis. So.
Oh, nice. Well,
yeah.
I've done something positive for the ecosystem. So listen, why don't we get started by having you guys tell us a little bit about your background. So we'll start with you, Bruce. So I think you had a career before becoming a VC. So why don't you tell us a little bit about that?
Yeah, actually, VC is my second career, and at this point, I guess about equal amounts of time in both of them. I started out as a lawyer, graduated from UCLA in the early '80s, and started the practice of law actually with the biggest Orange County firm at the time. I think now it's our sponsor, Kenobi Martins, but at the time it was Rattan and Tucker, which was a wonderful place to start practicing, and got a chance to try different areas of law and really gravitated toward corporate law, representing companies and doing financings. And one of the first deals I did was venture financing with Ted Smith, who was starting a company called FileNet then. And that actually later grew into one of the early juggernauts in Orange County tech. And then later that decade joined Morrison and Forster when they opened an office down here, became a partner there. And then got recruited by Brobeck Fleger, which was one of the big, another big San Francisco firm that was opening an Orange County office and asked me to kind of head up their information technology practice here. And I did that for 7 or 8 years, left at the end of 2000. So was very busy for a while there, particularly in the late 90s during the first tech boom.
Right. Well, you certainly caught that at a right time. In fact, you represented, if I'm not mistaken, you represented one of our big Orange County success stories. Is that right? Did you hear that, Bruce? Yeah.
I'm sorry, no, having a little bit of technical difficulty here. So please repeat the question.
Hey, so I said that during that time you represented a kind of one of the big early Orange County success stories. Is that right?
Well, several of them. I was lucky to. Started with one called Peargain Technologies, where Henry Samueli and Henry Nicholas were executives there. Did Peargain's IPO, and then a couple years later, rejoined the Henrys when they were still up in LA, and worked with them in the early days of Broadcom. The first time I met with them, under the Broadcom banner, I think there were about 18 people working for the company, and it was just a few steps away from UCLA campus, where they were both still on faculty or postdocs. And then did that IPO in 1998. Actually, I'm using my binders from that IPO as a prop to get my laptop high enough here. So I can tell you the date was exactly April 21st, 1998, when they went public. And at the time, it was $24 a share, and they raised $84 million, which was just at that time, a massive IPO. So that was fun. I also worked with Buy.com and did their IPO, and that's kind of where Sherman's path and mine first crossed.
Cool. Hey, listen, someone already threw a question there, and it kind of ties in with what I was going to say. So Jeff Minhas kind of hinted that you may be a UCI grad, and I know that you were also a UC Regent, so you've got kind of deep UC blood. Is that right?
That's right. UCI undergrad, UCLA Law School, and then a lot of involvement with UCI in various roles subsequently. Including the pleasure of meeting Jeff when I was involved with the Alumni Association for a number of years, about 7 or 8 years ago.
Why don't you go ahead, unmute? I think that background noise there. So Sherman, why don't you unmute and tell us a little bit about your background?
Sure, happy to. So I kind of came into the venture world from what I would consider a very non-traditional manner. I started my really kind of career, I went through the Navy's nuclear power program. The Navy decided at their pleasure to send me to Purdue University on a scholarship. And then when I graduated from Purdue, I actually majored in Russian, and I became a Marine Corps officer and spent the next 10 years as an intelligence professional. And this is in the early 90s. And a bulk of my career has been in Southern California with a small stint in Hawaii. But that early year, or those early years as an intelligence professional, the reason I mention is it really shaped the way I thought about remote sensing, data analytics, predictive analytics, algorithms, drone deployments, because as you know, that stuff was being done in the classified world for a very, very long time. So it gave me the exposure to things now that people think about and that we invest in that they think are new, but that stuff has been around for a very long time. So it gave me a very unique perspective about data. And then that transitioned very well to my first startup, which was late 1999 in Orange County, in Aliso Viejo. Well, we were purchased by Buy.com. And then I transitioned into Buy.com, became the chief operating officer, and that's where I met Bruce. So that was almost 20 years ago. And then I spent about 18 years as an internet operator, both with private companies, growth, scale. My last operating gig was at a public company in LA called Intermix Media, which owned a very small property at the time called MySpace. And we went through and did a turnaround, relisted them on the American Stock Exchange, cleaned the company up, and then we ultimately sold it to News Corp for about $670 million in 2005. And so after that, I transitioned to the other side of the table. So I took that operator perspective, that entrepreneurial perspective, and then I switched sides and went over to the investor side. I worked for Austin Ventures for a couple of years. And then in pretty much, if I recall, it was about mid-2013, and I've always stayed in touch with Bruce. Matter of fact, I used to pitch Bruce all the time as an entrepreneur, so it was pretty funny. And then in 2013, we really started talking about an investment thesis around the proliferation of these data sets and how they were morphing with all these smart connected devices. And that led us to really what we consider, a very sector specific fund in Orange County called Miramar Digital Ventures. And so we launched that in 2014.
Excellent. Yeah, obviously we're gonna dive into that. Maybe before we do, Bruce, why don't you kind of just fill in that little gap there? So tell us a little bit about when you started Ventures and about Miramar Venture Partners Fund 1 and Fund 2, because you guys are Fund 1 and Fund 2. You guys are up to your 4th fund now. And remember, you're on mute. There we go.
Got it. Yes, so just very briefly, around 2000, I was having breakfast over at Pacific Way with Henry Samueli, still a lawyer, and we started talking about kind of the state of venture capital in Southern California and Orange County, and that led to kind of the creation of the first Miramar Fund, which was, from an investor standpoint, headed up by Henry and other executives from Broadcom, with a thesis that there would be semiconductor and communications startups that would be interesting acquisition targets for Broadcom and other companies, of Broadcom's ilk. There were a lot of semiconductor companies in those days, a lot more than now. And a number of them in Southern California, of course, a ton of them in the Bay Area. And so we launched in 2002 the first Miramar Fund, which was a companion to Broadcom, and collaborated with Broadcom in evaluating later stage deals that were of acquisition interest to Broadcom. And so that was pretty much how I spent my 2000s. In the second half of the decade, it became pretty clear that Broadcom, was going in different directions. There were management changes. And so they weren't going to be a buyer of these companies. So both myself and my colleagues here really started to focus on finding homes for those companies that we thought Broadcom would buy. And we ended up selling most of those companies to, sort of everybody but Broadcom, to Qualcomm, to LSI, to Akamai, to Cisco, to Western Digital. And, that turned out to be a great experience too, because I got a chance to do both sort of the buy side in investing in these companies, and then the sell side in terms of, the exits, which are an important part of that.
Not to mention, you got to kind of engage all those additional acquirers and kind of corporate entities.
Yeah.
Good stuff. Okay, so then, Sherman, you started to kind of touch on it there when you guys came together. So why don't you fill us in a little bit more then? Kind of a little bit deeper dive then on Miramar Digital Ventures, how it's different from what Bruce was doing before, and what your strategy is then around data. Sure.
So the original thesis and how we structured the investment and how we looked at the roadmap in the sector was really along this is 2014, was along that evolution of the data sets. And, we both were intimately involved. Bruce had seen kind of the rise of a lot of these digital assets in the mid 2000s, late 2000s. I had been an operator. And then we started looking at really early stage and how we thought these companies were going to disrupt these certain sectors. So the original thesis in the kind of first 2 years was really along that data evolution piece and how it was impacted by the proliferation of, at that time, smart sensors, but there were a lot of dumb sensors out there. Now it's completely different, right? Pretty much everything is a smart sensor. So in simple terms, the way we looked at the ecosystem then was you had a smart connected sensor that was collecting data, which are ones and zeros. It was disseminated somehow. Usually in the past it was 4G, now it's 5G, goes into the cloud. Then that data is being parsed and there's being models and AI created around that data to extract a product or a service. And then that data is disseminated down to the end user in the form of a product or service. So we saw very early on AI really start to take off, and in particular machine learning. And so in the first fund, Miramar Digital Ventures 1, about 75% of our portfolio companies have a very significant AI component, and it's mostly machine learning, but there's NLP in there, which is natural language processing, image recognition, various different areas within AI. As you know, AI is a very broad category. So with the launch of the second fund, it just refined the thesis even further. We didn't shift really in our early stage focus, but what we did see was we're seeing a much more rapid evolution of AI, data science, and then a lot more connected devices out there. So when we think about opportunities within moving forward for the next 10 years, because we're basically long hold value-based investors, that is kind of our focus, and that has kind of always been our focus with regards to the fund.
Okay. Now, listen, it seems to me, from my perspective, almost every enterprise software company that I see now, and a lot of consumer software, frankly, says, and we've got an AI component to it, or part of AI. It seems like AI has almost become, almost, I'd say, synonymous with modern software companies. So how do you differentiate that? What, everybody can say they're an AI company, but what's kind of in your mind, dare I say, kind of true AI, or where does AI add value in your mind in terms of the companies that you look at, as opposed to something that might be more, kind of just pedestrian enterprise software?
Sure. So Luis, we always think about when we go into even an early stage deal and we look at basically their value proposition and their offering, and we're very heavily focused on AI enabled software. That's a big part of our overall investment theme. But when we go in and we look at that, we always start with the use case. What's the output and what are they trying to do with AI with regards to the vertical they're trying to disrupt? And so we always kind of start with that. And there's certain verticals that are adopting AI quicker than some other verticals. High tech, automotive, telecom, finance are great examples. Healthcare is another good example. So we always kind of start with the use case in mind, which is usually the first filter we look at when we scrub these companies. And so because AI is a very broad term and the entrepreneurs are very smart, everybody's putting AI in their decks, right? But we go very deep from the start to figure out if it's real AI or if it's pseudo AI. And we get into detail around the data set. We get into detail around the AI tech stack. So we can very quickly find out if it's real AI or if it's pseudo AI. So that's one of the determinants, one of the filters of what will pass our filters with regards to that. But most importantly, the use case, the outputs, and do they have the capability to disrupt the verticals that they're going after? And that's not an easy problem to solve for. In the past, and what I'd say the past 10 years, you see a replication of a lot of similar business models. We're looking for very disruptive things in the AI space. And we're vertically agnostic. We have some very specific focus, but if we see disruption, for example, it could be in logistics or supply chain, very interesting to us. Healthcare, very interesting to us. Public sector, very interesting to us. So, but we want to see disruption. We don't want to see replication.
Got it. So definitely the data set matters, the tech stack they're using clearly matters, and whether it's going to be disruptive kind of in that use case. So it sounds definitely kind of vertical market AI kind of interested there. What about horizontal platform plays? Are you guys doing any of those that you kind of make AI applicable to other companies, kind of and those horizontal things within that data stack?
Well, I would say within, again, we tend to be very vertically focused when we think about it. So it tends to be very vertically focused on an industry. And we like to see a rifle-like shot on disruption within that vertical industry, right? Specific use case. And then if we see broader applications of the company as it scales, and that's much more of a portfolio management question than it is a early stage deal flow discovery question when we're first making the investment. That's very interesting to us as well. And you like to see that expansion, but early on for the seed stage stuff, we like to see a very tight focus of what they're trying to go after, because those are big sectors and big verticals that we're targeting. And you know, one of the classic things that a lot of the entrepreneurs get into is they try to take a shotgun approach to sales, not a rifle sniper shot approach to sales. And that makes a big difference, cash flows, how it scales, how you scale the team, all those things. Yeah. We like to see a tight focus.
Yeah, it's interesting. I think you're certainly onto something, in as much as PitchBook, one of their reports recently on AI, they broke it into their different categories that they look at. And they said for the horizontal market, they projected that about a $4 billion market, horizontal tools within AI. Vertical markets, 39 billion. So you can see 4 billion to 39 billion, a 10x kind of increase there on those vertical markets. So that's really kind of where that disruption will be. What about AI as it goes to kind of end products? So whether it's autonomous driving or kind of what you talked about earlier, the robotics, drones. Have you guys thought about that as deep as getting into real world physical products? And someone also threw in a question about VR, for example. So
Sure.
How do you think about robotics, autonomous driving, drones, and VR?
Well, they're all subcomponents of AI, if you really think about it. And so we tend to be very heavily software focused. We have invested in hardware companies in the past, but those are hardware components that we look at as those are the connected sensor aspects of the value chain, but they all have AI components as far as the software behind the scenes. Those sensors are collecting the data sets, and then their algorithms are producing some value add or some form of intelligence with regards to the output. But we tend to be very software focused on how we think about AI. We've looked at a lot of stuff in AV, autonomous vehicles. We've looked at quite a few things in robotics, particularly in logistics and supply chain and food production. We've looked at drones in the public sector, like Androl up in Orange County, which is, great, business for Lucky Palmer. So those things are interesting to us, but we tend to be much more focused on software. Hardware, this is a great quote in the industry, you've probably heard it before, hardware is hard, right? And when you think about scaling the business, you've got physical inventory, you've got real costs behind the hardware design. We're not adverse to it, but we tend to lead with software.
Got it. No, that's great. And thanks for letting me kind of go deep. Bruce, let's bring you back in here. So why don't you tell us a little bit about how you've thought about the financial strategy then? I know one of your thesis or one of your kind of strategies is seed and feed. So can you tell our audience about seed and feed and how it affects? And remember, you're on mute.
Thanks. Yeah, I'd be glad to. It was in some respects sort of created out of necessity because, we're a small fund and we were looking for, and this goes back, almost a decade now, looking for advantages as a small fund situated, excuse me, here on the ground in Southern California versus a big fund, mega fund in Northern California. And, there were a couple of ideas. One was that we're a lot closer to the founders and probably have visibility, out of that network of founders that we both have that goes back, a couple of decades when they start new companies. And so we can be, kind of the first investor, even at the seed stage, albeit as a fund, alongside angel investors and the founders themselves. And then the other thing is that because of the failure rate of young companies, all other things being equal, great teams, great markets, you still have a competitive environment where, they don't know who else is doing this, what advantages they have financially. I mean, a good example of that actually is a company that I got involved with in the late 90s when I was still at Brobeck, called Applied Semantics. And Applied Semantics, two brothers, Gil and Eitan Elbaz, who were brilliant, great team that they pulled together from mostly Caltech and UCLA grads up in LA. And they were doing a new generation of search engine. Unfortunately, at the same time, there were some guys up in the Bay Area who were doing that, and their company was called Google, and they had a ton of financing, they had a ton of resources, starting with Stanford. And instead of, folding their cards when they saw this, Gil and Eitan and their Applied Semantics was chronically underfunded. But they realized, well, what can we do differently that Google doesn't do? And they started building a patent portfolio around the correlation between search and advertising. And by the time Google was getting ready to go public, they realized, uh-oh, we might need what Applied Semantics has. Google acquired Applied Semantics a year before they went public. And the rest is history, obviously. Gil and Eitan both stayed with Google for quite a while, developed some great relationships, but returned to or remained in Southern California and have been part of the entrepreneur ecosystem here ever since. I mean, some of the best ever. And so that was an example of an underfunded Southern California company that was, great to be with, from their seed round.
Right.
And I thought, well, if we can replicate that, even if we only have 20 or 30% of our portfolio succeeding, we can still do well. And we can also, scale up with the winners in that portfolio. So that was really the point of seed and feed. Our goal in the first fund was to do 25 companies and have, maybe 4 or 5 of them be successful, out of our seed investments, using it as a discovery process. We have at least 10 that are successful. And with the new larger fund that we started closing on earlier this year, we're able to do crossover investments. In addition to a whole new crop of seed companies, we'll do another 25 or 30 in this fund, and kind of roll along in a new and different model.
Yep. No, that's great. I love that strategy for obviously a couple of reasons. One, with the ability to plant more seeds, to get it spread out more broadly, is going to help a lot more entrepreneurs here kind of get their companies that initial capital. That's terrific. Why don't you tell us a little bit, or let's dive in, spend some time looking at some of those companies and some of those investments. So why don't you, I'm not sure which one of you wants to start, but why don't you guys tell us about, I think Scopely was the first one we're going to talk about.
Sure. I'll tell you a little bit about that. That's a company that we became acquainted with during the seed stage. Some rock star founders, one of them being Eitan Elbaz, who I mentioned in the context of Applied Semantics. And so we were part of their angel round, which was a convertible note, and then continued to scale with them, through subsequent rounds. They were really just, it was kind of like the Broadcom or Applied Semantics startup story, where they were in, these kind of, dodgy old quarters in a building behind the Wiltern Theater originally. They were very secretive about what they were going to do, but they were going to use, data science and AI to correlate, social with mobile gaming. And, that was, earlier this decade. At this point in time, they're, one of the, great stories, not just in LA, but nationally in terms of mobile gaming. One of the biggest players, probably have the most consistent track record with hits across both the kind of more social gaming and mid-core gaming, including the whole Star Trek properties, now the Marvel properties that they acquired from Disney via Fox Next. And, everybody's kind of waiting to see. They've been a huge beneficiary of COVID. Kind of sad to say there's any beneficiaries of it, but it's changed the world as far as tech and how people interact with each other, or at least accelerated changes that were already occurring. And one of those is through mobile gaming and the social connectivity that occurs there. And they've just done a phenomenal job of leveraging that both pre and now post-COVID.
Yeah, and they've grown quite significantly in value too. So I don't want to put you on the spot on something you can't disclose, but they raised a round not too long ago that put them in some pretty lofty air, if I'm not mistaken.
That's true. The last round, the post money was about $2 billion,
Nice.
and I'm certain that over the next couple of years, that will end up looking like a lower altitude.
Yeah, no, that's perfect. I'll give a little feedback on that. Travis, let me know if you're still hearing that. So, one of the things one of the sayings I think is certainly true in venture, or as well as many other things, is that, success has many fathers, but failure is an orphan. I'm surprised that, there's quite a few investors that hang their shingle on Scopely. It's like, we were there, Scopely's one of ours, because they're a great Southern California investment. Hey, Sherman, why don't you take the next one? Want to tell us about one of your portfolio companies?
Sure. I'll cover, just to give the audience just more of a seed and feed stage, or really seed stage decision for us. So recently, based on a specific theme we have in the healthcare space with regards to AI-enabled software, we did a very targeted search to look at seed stage companies that we thought could disrupt a portion of the healthcare industry, in particular around staffing and temporary staffing in the healthcare space. And if you think about the healthcare space, it's not just doctors, nurses, there's orderlies, there's a lot of other folks that are associated with healthcare and care overall, from hospices to hospitals to across the board. And so that targeted search led us to a company that we found in Oslo, Norway, which is called Globus Ai. And they had a couple things, and this goes back to kind of our investment philosophies, Luis, too, around management, market, business model, moat, and then that deep quantitative dive into the AI tech stack. So they exhibited all the really good attributes of that. And they created some very interesting AI-enabled software that allows healthcare staffers to increase their efficiency in their processes when it comes to hiring temp workers, which was very, very relevant in COVID and is going to be relevant moving forward. So they created some very unique products around that. The team has an extensive knowledge in data science and AI. They came out of the oil and gas industry. They had experience in the healthcare industry. But this is an example of when you're just having discussions on the AI tech stack with the team, they could talk to you for days about AI, which is usually a good filter to figure out if somebody really does understand it. So great team, great founders. Most of their clients, this is a seed stage deal, but they actually have quite a few clients already, and it's post-revenue. They're doing pretty significant MRR and ARR because they're selling their software as a subscription service. And so the company has done a really good job. And then their next look is how do they tap into the US markets, which is why we got interested. And we start to think about how can we add value? What networks can we tap into? But we're going to take that in a very thoughtful approach. First and foremost, they're focused on Scandinavia and Europe. And then they're already thinking about and just landed their first client in the United States. So that's a great example of a very early stage company. We led that round, and then we helped them syndicate the round with other investors.
Perfect, perfect. So you've got a global view is in addition to your local view, but how they'll leverage the U.S. market's definitely important. So it ties into one question. I'm going to go ahead and cherry pick this one off a little bit, because you said that Globus focuses on healthcare industry, specifically how AI can manage their temporary hires, if that's right. Have you looked at any AI as far as it helps diagnostics? And that area, particularly the challenge, I think, is whether physicians and payers will adopt this AI-driven diagnostic. So any experience in that? If not, we can move on.
We have.
Oh, good.
And we've looked at not a lot, but quite a few in that space. But we have some very specific thoughts and conviction around certain themes in the healthcare industry. Diagnostics is one that's not really of interest to us, but okay. AI is going to be very, very relevant in that category.
Okay, cool. Hey, Bruce, let's have you describe a third one, but I realized we kind of missed an aspect when you're talking about the financial aspect of seed and feed. So what does it mean in terms of kind of dollar ranges on seed and feed and kind of valuations? That's a fair question. We probably should have touched on it.
Yeah, sorry I left that out. So our dollar ranges at the seed stage are, kind of in the 100 to 500,000 range. And a lot of it has to do with sort of the size of the round. I mean, we're talking to some entrepreneurs right now about a seed round that's, 500K. So in something like that, we might be on the lower end of that range. But there are, seed rounds, typically these days, especially if they're successful serial entrepreneurs, where there'll be $1.5 to $2.5 million early stage seed rounds or even convertible notes, and so we'll be kind of on the higher end of our range on those situations. We, as far as later rounds, I mean, with the new fund, which, we're hoping to reach $100 million target soon on that, we're pretty close. That gives us the ability to put a lot more money to work across more rounds in the company and later rounds. So we would see ourselves, doing kind of $1 million to $3 or $4 million per round. Once companies get to, series B's, C's, D's, et cetera. And one of the local companies, we actually just came in, we've known them since they were founded. They were a little too late for our first fund as far as a seed investment, but we stayed in touch, and they have, some great local founders. Kurt Busch is the CEO. And there's a rock star team from Broadcom that's accompanied him, Peter Vorenkamp being one of them. And so that's a company called Sentient that has created some of the very first AI chips utilizing machine learning to identify, activate, and authenticate edge devices. So like if you had earbuds, and they wanted to make sure they're your earbuds instead of, going through the cloud, pinging CPUs. This can all be done on the edge using these, microscopic sentient chips. And they've been on a tear. I mean, they've actually shipped more than a million units already. They, in a very short time, created a dedicated brand new chip architecture with a deep learning training, and then collected the data to make production models. So that's just a fabulous local story. And it kind of comes full circle too, because it's the merger of our thesis around AI, Southern California entrepreneurs, and we're back to a chip company. So
no, yeah, you're right.
We're thrilled with that.
Yeah. I love, if Bruce, if you can mute, I love
Sentient and Kurt, and one of the things I like about Kurt is when he said nobody was crazy enough to start a fabless semiconductor company in 2017 or 18 when he started that. So I think that's terrific. Hey, we've touched on it a couple times, Bruce. So why don't we dive into it a little bit more? You've mentioned your most recent fund. So tell us about your most recent fund, and actually you've got some interesting background there on one of your anchor investors in that fund, the OC Master Fund from the CEO Leadership Alliance. So can you fill us in a little bit on that whole story?
Yeah, hopefully you can hear me, and I think I heard most of your question, Luis. Having a little instability here on the Zoom, but yeah, on the newest fund, we're targeting $100 million. We closed on a majority of that earlier this year, and are continuing to roll up closes. We just had another one last week, so it gives us a lot of optionality that we didn't have with the first fund in terms of some later stage deals that have been de-risked but are in the pipeline. Because we've been with them since the beginning, new ones like Sentient that we were able to be close to. And I have to give, just full credit to kind of two sets of limited partners, one being partners who were with us in the first fund and, are coming back or have come back and are very supportive, including the Samueli family, and then new LPs, and that effort has really been led by the OC Master Fund, which is the first no load fund of funds that's based here in Orange County and is focused on really developing the venture ecosystem here. So we're delighted to have them and be one of their first investments, have them as our LP. Visionary Ventures, and I know you had Jeff on an earlier show, is the other fund, more on the ophthalmology side that they've backed. And over time, as they raise more money, they're looking to back more funds that are committed to Southern California, and just a great partnership. I mean, Dick Gocknauer over there has been wonderful. Greg Wortman over there is great in terms of not just being a sympathetic LP, but also he has great deal flow in his own right. So great partnership, and we're happy to see them joining the UCI Beal Innovation Center and Octane as part of our kind of core infrastructure here.
Yeah, no, obviously that's a great thing that has happened with the OC Master Fund and the ability to kind of anchor Visionary Ventures, Miramar Digital Ventures, and to move on from there. So Sherman, let's talk, if you don't mind, a little bit about your investment process. You've already told us about what you think about in terms of analyzing the company. Give us a little bit more of the kind of the nuts and bolts. What's your meeting cadence with startups look like? What does your due diligence look like? Someone in the chat or in the Q&A is asking about how do you avoid conflicts with existing companies? How important is that for kind of overlap with existing companies? So can you touch on the nuts and bolts about how you manage the investment process and what entrepreneurs and founders can expect?
Sure. So one of the key things I think that's important to understand about Miramar Digital Ventures is, having been an entrepreneur before and having raised money myself before and been in their shoes and on the other side of the table, we're not slow maybe investors. We're going to let you know very quickly if you pass the high level filters. And if you're not, we'll tell you no. And we just do that because one, it's a disservice to the entrepreneurs. And I've been in your shoes before, so the slow maybes are the worst ones. But Luis, we look at it we're very specific sector investors, and we have very specific convictions and investment themes and sub themes around these sectors. So when we look at deal flow, for example, I'll probably see easily 3 to 5 deals a day. unsolicited. And then when we go out and proactively hunt and through our referral network, we'll look at, I've probably already screened this year, I think between Bruce and I, we've probably already screened close to probably 500 companies. We've made 3 investments. So we're very quantitative at the start. We're also very qualitative on the early stage stuff, because the qualitative aspects of the management team, the business model, the target market, the moat that they're trying to build around that, there is a very heavy qualitative aspect to it. Where we get very quantitative is on the tech stack, the financials, the business model assumptions, and then we're very quantitative on the follow-on feed stage decisions we make into the portfolio companies. Much more performance driven, very, very quantitative on that side. So, and we have to be, because we have to be objective when we're making these investment decisions for our LPs. So when it comes to conflict of interest, we tend to shy away from that. If we invest in a company that's in a particular sector doing a particular thing, we usually don't go look for other companies that are similar. One, it's kind of a disservice, and we've seen many examples of this where an investor invests in a certain company, he gets on the board of another company, they share ideas. You're not doing anybody any favors there. We like to kind of be very specific. If we're going to place a bet around a company, it's most likely going to be very specific to that company. And so we're very thoughtful about that. So that kind of answers that conflict of interest question.
Good. Thank you. Thanks for going through that. Hey, Bruce, one of the things I've been impressed with you over the years is your ability to kind of attract experts, entrepreneurs in residence, venture partners, et cetera. In fact, you snagged one of the really great people coming off of a nice exit here recently to help you out. So tell us about how you use those venture partners and EIRs at Miramar Digital Ventures.
I think it's a great way for us to both give somebody who's, in most cases, come out of a nice exit somewhere, and they're still trying to figure out what they're going to do next, to decide, either by, kind of looking at deal flow and, contributing to our diligence in our deal flow, or, do they want to start another company? And it's one of those things where it's an advantage to having a big network, a network that's been around for a long time. I mean, the person I think you're referring to is Stuart McClure, who was the founder and CEO of Cylance, sold it to BlackBerry early last year for, $1.5 billion exit, and kind of thinking about, what his next act is. He's still relatively young. And so it's a great opportunity for us to, really add to our capabilities, because we've never invested in cyber. We didn't feel like we had the expertise within the firm. Stuart certainly brings it, and he brings a great background in AI as well. So it's been a wonderful collaboration over the last, 6 months, and hope it continues for a long time. But Stuart at some point might decide he wants to, start or join a new company. If he does, we're there with the checkbook. And if he doesn't, we hope he, kind of falls in with us. I mean, Sherman was effectively an EIR with us at one time as well. Other people who've done that are Steve Yamamoto after he came out of Qualcomm, and now he's running one of the late Miramar Ventures companies. Armand Harapetian when he came out of Broadcom, and he started a company which we backed, and then he's continued on in a number of different entrepreneurial endeavors, and helps us vet deals. So it's sort of like having a deep network, a deep bench, and it's a great way to kind of give people who've are waiting for their next act someplace to come and work and be intellectually challenged, and it's an advantage both ways, I think.
Yeah, it certainly sounds like that. Hey, Sherman, why don't you give us kind of your perspective here on I think during this VC speaker series, we've talked a lot to the VCs about, how they adjusted in March, what they did, et cetera. And I think we've heard a lot of interesting perspectives, but with you, I think I'd rather kind of look forward. So what's your outlook here for 2020? What's your perspective on what 2021 is going to bring?
Yeah, so it's a great question. And if you think about it, Bruce and I have been through, I've been through three basically secular bust: 2000, 2007, and COVID. And so when you look at the early stage sector, again, I think entrepreneurs can look at it a couple different ways. And I'm a very opportunistic and person when I think about the future of being an entrepreneur. You can either think about the impact of COVID and let it paralyze you and think that you're not going to be willing to take the risk moving forward, or you can think about 2021 in particular and think the cream's going to rise to the top. A lot of entrepreneurs probably aren't going to start companies because they're going to be afraid to, because there's a lot of uncertainty in the market. And if you think about some of the top tech companies that were created, they were created after financial recessions. 2000, Google, Facebook, the top ones, right? So I think the entrepreneurs that have, one, the conviction, the work ethic, and really disruptive ideas come 2021 are going to be in a very unique position. And there is a tremendous, as you know, Luis, amount of dry powder that's sitting out there. So those guys that are going to be able, and gals that are going to be able to create these companies with a very unique proposition, they're going to be in a very, I would say, opportunistic scenario to create a lot of value and create a really good company. And I think it's going to force a lot of people, it will weed out the weak when we think about it. So I look at it in very positive terms. It is what it is. You can't do anything about it. But let's think about what 2021 is going to look like. And then as an entrepreneur, the world is your oyster. Go for it. Have conviction, because if you do have a good idea, you're going to be able to find money behind it.
Yeah, no, those are inspiring words. Yeah, and certainly, so we share those that outlook, and the data supports it. These great companies that have been started in downturns really seem to outperform. One of the attendees asked a question that kind of ties into what you were saying earlier when we were talking about conflicts. What about synergies between portfolio companies? So you guys have Ratio, another portfolio company that we didn't talk about, but a lot of people are probably familiar with. They make the smart automated water sprinkler systems. So what about, any synergies in water technology now that you have Ratio in your portfolio, or does that get iffy?
As long as there's not a direct conflict, we do look for that. But as you know, when you're managing the portfolio, we're always looking for opportunities to have one founder, that could potentially benefit another founder in the portfolio. But we don't force that option. It's got to be led by the entrepreneur. So, and we don't purposely construct the portfolio that way. We tend to like having uncorrelated positions in the portfolio. And that's why we don't tend to be investing in a lot of the same stuff in the same vertical. And that non-correlation is very effective. It's almost like a hedging mechanism with regards to portfolio management. So we look for it mostly after the company's a little bit more mature. For example, we've done things with Embrace that does mobile apps optimization. We use some very sophisticated technology to do that. We've made introductions to a host of our portfolio companies because it's very relevant to their business offerings, right? And so Eric Footeran, who's the CEO, another former Scopely guy, who went and created a great company. We'll do it from a business development and client perspective, but we tend not to go, oh, we're in this, water conservation, smart home area, and let's go find 5 other investments in that. We like to be a little bit more diversified for that because of that uncorrelated aspect.
Yeah, no, that's kind of basics there of portfolio management for one. You want to get those, so that's smart. A couple questions. You mentioned kind of the early stage companies and those that are able to build moats around what they're doing. So what kind of qualifies as a good moat? So some examples here: network effects, IP, brand strategy. What makes a good moat around an early stage company?
I would say really more, again, I think I would define it from a customer perspective. So when you think about, Ratio is a great example of that. They were able to they have 520,000 customers. They were able to create a very solid and formidable brand around that. Those are interesting things. But you can't really tell those things until the company's a little bit more mature and developed. When we look at early stage stuff, we tend to dig into the data set. We tend to dig into the service offering. We tend to dig into the use case. And how quickly do we think they're going to be able to get scale and get traction around that use case? Look, hyperscale is what we think about. We're venture investors, right? If you build a very highly scaling company, but not at all costs, it's got to have fundamentals. Exits are easy, right? So building a moat around it comes with time, like brand. One of the things I think is a little bit of myth in the technology space is people coming in with real hard science and real heavy tech oriented early stage stuff. And they'll pitch us and say, we have 40 patents. And patents are not a defensible moat in my mind moving forward. They're really not. So unless it's something very, very deep tech, right? They help, but they're not a defensible position in my mind for building a moat like they used to be 20 years ago. So I think that's a myth that floats around out there. I'd rather see an unbelievable disruptive business model where these guys can sit. Network effect is a great example, right? Two-sided marketplaces with lots of supply, lots of demand, real big gross market value transactions going through that. Those are big moats, but they're mostly around the business model. So patents, not too interested. And a lot of people tend to lead with that, especially if they come out of the academia.
Yep. Hey, no, that's a great insight. So we're getting really close to the end of the hour here, and I like to make sure I finish these things on time. So a reminder for those of you that can put in the specific questions about are they interested in or what do you see about in this particular area, those may not be that much value to the rest of the audience. So Sherman and I'll hang around afterwards and try to answer some of those. But for now, Bruce, maybe I'll give you kind of the final word. You've seen a lot here in Orange County. A lot of changes. So kind of what are some of your final words and advice to the founders out there and status of what's going on?
Great. Well, final word. I don't know. There's never a final word, but a little bit of advice, I guess I'd say is, we are more challenged here. I mean, one of the things that has always been difficult as far as being either an entrepreneur or a venture fund, and believe me, Sherman and I can empathize with entrepreneurs as far as the fundraising process. When you think, how much wealth is based in Southern California and how little of it is, really wants to invest in tech startups, it can sometimes be, frustrating to say the least. But I'd say, one of the keys is, take the leap, feel the commitment, stay focused, and you don't worry about, raising, a targeted amount of money. If you started in your, thinking I want to raise a $5 million, series seed before I, leave my old job and start this company, think about whether you can do it on 500,000. And you can probably get the money that way, because we do have a great angel and seed network in Southern California. We just don't have the big pots of money that they do in Northern Cal. We can access those later. Hopefully there'll be more of us with bigger pots in the next decade, but make sure a little bit of gas is enough, and a lot of commitment and brains and hard work will get you there.
Now I almost forgot to unmute. Well, I think that's a great place to end it. Bruce, Sherman, thank you so much for your time and for your insights. This has been a wonderful conversation. As I mentioned, Bruce has got to go, but Sherman will hang around here for a couple of minutes and we'll answer some of those questions. So for now, I think we'll go ahead and start wrapping it up. So before I go, though, I once again would like to thank our VC Speaker Series sponsor, Kenobi Martins, where you'll find a unique intersection of technical intelligence and legal acumen for a world powered by innovation. And I'd also like to thank our production team for this, our technician, Travis Rubido, who's at UCI BL Applied Innovation. He's a great help for getting these webinars out to our audience. And Travis, if you don't mind, if you can put the reservation link for our next event. We're having our next VC speaker series on October 2nd, and we're going to have Brian Messick from Ancona Partners on that. And the registration link will be in the chat, but it'll also go out through our regular email channels and marketing channels at UCI BL Applied Innovation. And then 2 weeks after that, on October 16th, we've got Sanjay Reddy from Unlock Ventures. So we've got a really great group here coming up. So once again, thank you all for coming. I wish you all a good day and stay safe out there.